today we're going to do two things. One is, of course, celebrate our birthday. It is 1 year since we launched the Thefynprint, and mark 6 months since we launched the Thefynprint global portfolio. So overall, the portfolio has given a return of approximately 15% in rupees in the last 6 months. In a sense, we were hoping for a 12% long-term rupee return, and we have already exceeded that expectation in just 6 months. Our investment philosophy is that the wisdom of the market is supreme, but there are slow-moving macroeconomic trends that you can take advantage of, and using which you can either reduce your risk or increase your returns or both. And to them, what we're doing is de-risking. We are moving their money from a single tech stock to a diversified portfolio of ETFs. And more importantly, for both groups of people, these are UCITS ETFs, meaning that their families are not at risk of US estate tax. Times when you will have second thoughts. But that is the time to accumulate. That is the time to step up your purchases. That is the time to keep your SIPs going if you don't want to take lump sum calls. That is not the time to panic. Hello and welcome to the Thefynprint. I am Neil Borate, and today we are going to do two things. One is, of course, celebrate our birthday. It is 1 year since we launched the Thefynprint, and mark 6 months since we launched the Thefynprint global portfolio. And it's important to mark this point, not because we are short-term investors or because we want to trumpet our performance in the short term, because we know that stock markets mean revert and it is the long term that matters. But we want to document our thought process and where we have reached, what we have done right, where we might have gone wrong, and what the future looks like. Helping me out today is my colleague Anil Poste. You may not see him, you'll hear his voice. So Anil, let's get right into it.
Yes. So my first question is, Neil, why did we decide to go passive and not pick stocks or individual geographies?
So a lot of people, when they invest, whether in India or outside, they like the thrill of picking direct stocks. Unfortunately, the odds are stacked against you when you do that. And that is especially true in the global market, where the index tends to beat the vast majority of actively run funds. And we are seeing this with Gift City, where the majority of actively run funds are underperforming the index, in some cases by huge margins. We did not want to go that way. We had seen the evidence, and that is why the portfolio that we created is a basket of ETFs. It's a passive portfolio, but it has our investment philosophy and our market outlook embedded in it. How? I will explain.
So what is our investment philosophy?
So Anil, our investment philosophy is that the wisdom of the market is supreme, but there are slow moving macroeconomic trends that you can take advantage of, and using which you can either reduce your risk or increase your returns or both. So what do I mean? The simplest thing that we could have done is simply bought the all country world index or the ACWI. That would have been passive investing pure. But there are things that have happened in the world market over the last few years that have led to index concentration. The US today is a good 65-70% of the all country world index, and the US itself is dominated by a handful of AI related stocks. The AI theme dominates in the world market, and while, of course, it is transforming the world, it's a revolutionary technology, there are risks that build up when people get over optimistic about a technology. So the portfolio that we built took passive investing at its heart, but we did some overlays, some broad overlays of ETFs themselves, such that we are going to cut risk or increase returns in the long term.
All right, let's move towards some holding level conversation now. Neil, could you tell us how has the currency effect played out? How does the returns look like today, and a little bit about tactical bets?
Sure. So overall, the portfolio has given a return of approximately 15% in rupees in the last 6 months. In a sense, we were hoping for a 12% long-term rupee return, and we have already exceeded that expectation in just 6 months. So it has, of course, been a phenomenally successful time for us. And during this time, by the way, the Nifty is down 6% in rupee terms. So our outperformance against the Nifty is a solid 21% in just 6 months. However, at the same time, there are areas where we have slightly underperformed. So, for example, against the All Country World Index, we have underperformed by 30 basis points or 0.3%. It is a very, very small margin, but it is a slight underperformance, and there's a reason for it. And if you apply that same logic to the S&P 500 as the benchmark, even though we do not regard it as the benchmark, then our underperformance is around 2%. Now, let me explain why we have to evaluate ourselves against all three benchmarks and why we are doing well against one, whereas we are doing slightly not so well against the other two. So, Nifty is our benchmark because the vast majority of our clients weigh their international exposure against their Indian exposure and they check who is doing how much. So, in their minds, their benchmark as investors is primarily the Nifty. And if you go down one level to the Nifty 500 as well, we still have managed to beat that index too by a solid 15%. So it's not a question of cherry picking indices on the India side. Now, some people go one step further and say, what about mid cap and small cap? Now, although on the small cap side, our performance may be somewhat similar, the point is any Indian investor trying to allocate money and trying to increase allocation towards small cap is actually increasing their risk because the small cap index is highly correlated with the Nifty. Moreover, the small cap index is also extremely highly valued. So I'm not sure if small cap is a fair comparison, but some people have made it on social media, and I want to address that point. Small cap is may match our performance, but it's going to increase your risk. Here we have a very low correlation with the Nifty, and we have beaten it by a significant percentage. So that's where we stand on performance. Now, how do the individual sleeves of the portfolio, how have they performed? So roughly, if you take this 15% return, it's broken down into 10% dollar return and 5% return from the rupee falling, INR depreciation. Now let's look at the dollar return. Where did that come from? So, of course, the all country world index, the ACWI, has gone up by roughly 10%, and that matches or slightly exceeds by a small whisker our portfolio return. Now, the second component, the emerging markets index, is up around 8%. So, it is below the ACWI, and we think that this is going to change on the long term, which is why we continue to hold it. And the third component, which is the tactical component, has on average given the same 10%. How? Well, it has three subcomponents. Number one is energy, number two is mining, and number three is US small cap. Now, number one and number three have given 15% return. Those bets played out extremely well. US small caps rallied and covered some of the gap that they had with US large cap. And energy stocks, which is oil, of course, rallied massively when the US Iran war broke out and continued to rally. There were false alarms about the war maybe coming to an end, but that has not happened, and those stocks have done extremely well. The one component that did not play out at all is the mining component because at the time that we purchased it, it had already had a significant rally and there was a pullback. So that component, the mining component, has not given any return, which has pulled down our tactical component return from 15 to 10%. So on average, the portfolio return is 10% dollar terms and 15% rupee terms.
So Neil, basically you're saying we are underweight US as against ACWI. Why is that? Do we expect US to struggle, and what are some reasons?
So if you look at the US debt to GDP ratio, it is at a historic high. if you look at the US total debt at $40 trillion, that too is at an unprecedented high level. The US fiscal deficit to GDP is around 5.8%. All of this is flashing red. We believe that we are close to an inflection point where US starts shedding its weight in the global market because government finances are entirely out of whack. Already some of this is happening if you see the performance of, for example, European stocks over the last 6 months. And if this trend accelerates, I would expect the S&P 500 to not do as well as the all country world index and to not do as well as our portfolio.
So since we have completed 6 months, we have taken a stance of not churning or making any changes to the portfolio. Why is that?
In our view, 6 months is too short a time for any of these components to fully play out. So the trend of market share shifting away from US mega caps to the rest of the world is a very slow moving trend. And it has to play out over the next few years. It cannot play out in a matter of few months. That is one reason why our weights to the all country world index and the emerging markets index have not moved. Now, the base of the all country world index remains the US, and their US earnings have been phenomenal this quarter. 50%, 50% earnings growth. And this has brought the S&P 500 valuation, the PE ratio back down to 20. Just by way of comparison, the Nifty quarterly earnings growth was 18%, and Nifty has the same PE ratio of 20. Indian investors are paying a lot more for this kind of earnings growth. Maybe S&P will decelerate in its earnings growth, maybe Nifty will go up, we don't know, but right now Indian investors are paying a lot more for their earnings. And let's take a minute to think about small cap as well. So even though small cap companies have seen a 30% kind of earnings growth, that index is priced at a 30 times multiple. S&P, to remind you again, is at 20 times. And we've seen no end of alarm and exaggeration around US valuations. Of course, US valuations have their risks. Of course, the AI story has its risks, but so does everything else, and so does the India story. There is nothing set in stone about these things. Our job is to diversify, to allocate our assets across different countries and different themes so that we are protected as investors.
So Neil, finally the question arises: who is this portfolio is good for? For beginners who have or people who have existing investments in global. And the second question is: what should be the approach of investing this portfolio?
So this portfolio is fantastic both for beginners and those who have already got some global allocation. Let me come first to the first set of people who have never invested outside India. And that, by the way, is the vast majority of our clients. We're introducing them to the rest of the world for the first time. And when you do that, you have to make sure that the portfolio is in a diversified, relatively low risk basket. Now, what most people do when they do their own version of self investing, when they are setting up their first global investment, they tend to buy the NASDAQ or they tend to buy tech stocks which are showing the most upward movement, which are already in a sort of massive bull trend. But this is extremely risky, it's extremely volatile. They are exposed to just a few names, and when the crash comes, they are scarred. They close their accounts, they do not return to this again. They don't understand that the purpose of the global portfolio is diversification. It is not trying to find the next multi-bagger. So that's the first set of investors. And all of those customers, by the way, had they remained only in the Nifty or in Indian indices, they would not have benefited from the vast amount of rupee depreciation that's happened in the last 6 months. Our portfolio gave them that shield, and our portfolio gave them a dollar return. We, as I said, we had expected a 12% annual return. In just 6 months, we came to 15%. We beat that expectation out of the park. So that's the first set of investors. Second set of investors, people who have already allocated some money outside, they often tend to be employees who have RSUs or ESOPs in their employers, which are typically tech companies and which have in the past few years made a lot of money for them. For example, somebody with NVIDIA RSUs would have accumulated wealth in the hundreds of thousands of dollars. And to them, what we're doing is de risking. We are moving their money from a single tech stock to a diversified portfolio of ETFs. And more importantly, for both groups of people, these are UCITS ETFs, meaning that their families are not at risk of US estate tax. So, as much as the strategy matters, the construction matters, the kind of ETFs you use matter, because those problems go far beyond a discussion on portfolio returns.
So, Neil, for both the category of people, for the beginners as well as people who have RSUs, as you rightly pointed out, say if they want to invest a significant sum of money, FOMO is real, right? About the global investing, how should they be approaching this? As should they stagger their investments, or they should go all in?
So, as we have said consistently before as well, they should be doing SIPs, they should be staggering their investments because it reduces the chance of catching a market high. If by chance there is a blowout in AI, or if by chance there is some kind of US fiscal crisis, there will be sharp dips in the world market, and that is the time to accumulate units. And your SIPs will do exactly that. You will get your units at a time when there is trouble in the world, when things have become cheaper. To all clients, we say that you must have a long term outlook, which means a minimum of 5 years. And it is actually in your interest for some kind of market turmoil to happen in the initial part, in the accumulation part of your SIP. Of course, in the long term, it doesn't matter whether the market correction happens now or later, but it does provide a psychological boost that you have got units at a time when they were priced lower. So absolutely, please do SIPs. Do not invest massive lump sums.
So, Neil, could you also tell us about the tax implication and the compliance around global investing?
Sure. So, for an Indian investor, because we have chosen UCITS ETFs, which are domiciled in Europe and not in the US, there is no problem with US estate tax. US estate tax will hit any Indian investor or any non US investor who has more than $60,000 of assets in the United States at the time of their death. This is going to create big problems with succession within families. So, this is one problem that we avoid with UCITS ETFs. Now, the second kind of compliance that Indian investors must do is fill their ITR correctly with the schedules on foreign assets. So, schedules FA, FSI, and TR. And that's something that our partner, which is PASA, provides to investors in a pre filled format. So, it makes their job a lot easier. When it comes to actual tax rates themselves, the long term capital gains tax is very much on par with Indian tax rates. The 12.5% that applies to Indian mutual funds and stocks also applies to US and UCITS ETFs. And by the way, this rate is much lower than what Gift City funds have to pay. Today, if a Gift City fund makes a short term capital gain, it has to pay 42.7% compared to slab rate taxation for an individual who's investing in UCITS ETFs. And in the long term, the Gift City fund has to pay 14.95% compared to an individual investor who is investing in UCITS ETFs. In both cases, you are paying a lower rate of tax. More importantly, as an Indian individual investor in the UCITS ETFs, you get the benefit of set off, for example. So if you have gains on your foreign ETFs and losses on your domestic ETFs or stocks, you can set them off against each other. Similarly, if you have losses on your foreign ETFs, you can carry them forward for 8 years. This is not available in Gift City funds at the moment. And when it comes to costs, Gift City funds typically have an expense ratio. If you're going through a distributor, then you will also have a commission embedded into that fund. Our product is possibly the lowest cost portfolio there is available. So, in terms of the future, what do we expect? our portfolio choices do not change. Nothing significantly has changed in the underlying ETFs. There are a few triggers that we are watching out for. For example, the ongoing or unfolding US fiscal issues. If there is a dramatic change in US policies, we will review our holding of US small caps, for example. Similarly, if there is a dramatic change in the geopolitical situation in the Middle East, we may review our holding of energy slash oil stocks. But all of this will be done with very careful consideration because any change in the portfolio will subject our investors to capital gains tax, and that will be slab rate because we have not yet completed 2 years. We designed the portfolio to be rock solid, to not force our hand and make us change things around too much. And that is exactly how it's playing out. Yes, of course, there'll be market dips. Of course, there'll be crisis. And of course, there'll be times when you will have second thoughts. But that is the time to accumulate. That is the time to step up your purchases. That is the time to keep your SIPs going if you don't want to take lump sum calls. That is not the time to panic. Heed my words now. At this point, when you are sitting on a 15% INR return, remember them, brace yourself because that is the nature of markets. And in the long term, I will see you on the other side, both in terms of being a wiser, wealthier, and happier investor.